Good morning, ladies and gentlemen, and welcome to Compuage Infocom Limited Q2 and H1 FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Atul Mehta, Chairman and Managing Director from Compuage Infocom Limited, for his opening remarks. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. Thank you for joining us on Compuage Infocom Limited's Q2 and H1 FY23 earnings conference call. I hope you and everyone around you are safe and in good health. Along with me today, we also have SGA, our investor relations advisors. We have uploaded our press release and results presentation on the stock exchanges, and I hope everybody had a chance to go through the same. Let me first start with business highlights. Starting with some key developments over the past 6 months, I'd like to share brief insights on recent developments regarding the company. We have made healthy progress on adding new brand partnership, as well as have signed up for distribution agreement with R&M India Private Limited to provide structured cabling solution to partners. We are also focusing more on higher profitable brands and categories to realign our capital and use it more efficiently to assure better capital allocation, and all new brand agreements are a step in that direction. Collaborations with such brands will allow us to expand our business in more profitable business segments, resulting in a higher return on capital, while also providing these brands with greater client reach, particularly in Tier 2 and Tier 3 towns and cities. Demand scenario from corporates and households continue to remain healthy. Strong demand across our product portfolio has encouraged us to report a robust revenue growth of 32% sequentially. Our strong growth in revenues has helped us to achieve healthy profitability, which is majorly attributable to increased share of value-added products and strong demand for IT products. Now, let me give you an overview of our consolidated Q2 FY23 results. Total income for Q2 FY23 stood at rupees 1243 crores as compared to rupees 1125 crores in Q2 FY22, up by 10% year-over-year. Gross profit for Q2 FY23 stood at rupees 58.7 crores as compared to rupees 53 crores in Q2 FY22, up by 11% year-over-year. Gross profit margins were 4.7% in Q2 FY23, which was similar for Q2 FY22. EBITDA for Q2 FY23 stood at rupees 34.6 crores as compared to rupees 29.9 crores in Q2 FY22, up by 16% year-over-year. EBITDA margins expanded by 10 basis points year-over-year to 2.8% in Q2 FY23. PAT for Q2 FY23 stood at rupees 8.4 crores as compared to rupees 7.5 crores in Q2 FY22, up by 11% year-over-year. Now let me give you an overview of our consolidated H1 FY23 results. Total income for H1 FY23 stood at rupees 2186 crores as compared to rupees 1790 crores in H1 FY22, up by 22% year-over-year. Gross profit for H1 FY23 stood at rupees 103.7 crores as compared to rupees 84.1 crores in H1 FY22, up by 23% year-over-year. Gross profit margins were 4.7% in H1 FY23, which was similar for H1 FY22. EBITDA for H1 FY23 stood at rupees 61 crores as compared to rupees 47.3 crores in H1 FY22, up by 29% year-over-year. EBITDA margins expanded by 20 basis points year-over-year to 2.8% in H1 FY23. PAT for H1 FY23 stood at rupees 14.6 crores as compared to rupees 8.6 crores in H1 FY22, up by 70% year-over-year. We believe that the penetration of IT products in India is lower than in developed nations, providing us sufficient headroom for sustained long-term growth. Going forward, we will continue to focus on adding new brand partnerships and agreements to widen our product portfolio and explore newer markets in order to scale up our business, which will lead to better value creation and profitability. With this, I now open the floor for Q&A.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and one on their touch-tone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Kanika Kothari from Kothari Securities. Please go ahead.
Hello?
Yes, ma'am. Please proceed.
Yeah. My first question is that are you in talks with more new brands for partnerships? Like how many new brand additions can we expect in the next 1 or 2 years?
Yes, this is a constant process that continues in Compuage. We are engaged in discussions with several brands to expand our product portfolio. We cannot quantify how many we will sign in the next 1 or 2 years. Our goal is to sign at least minimum of 6 to 8 brands every year. That is the goal that we are working towards, and we are very confident of achieving that goal.
Okay. The next question that I want to ask is like, what is the company's current working capital cycle? And I mean, has it improved as compared to the last year?
The cycle more or less remains the same. The current net working capital cycle would be in the region of about, I would say, in the region of about 50 to 55 days.
Okay, sir. Thank you.
Thank you. We have the next question from the line of Anjana Shah from Shah Investments. Please go ahead.
Thank you for this opportunity, sir. A couple of questions from my end. Just wanted to know on the receivable front, are we facing any challenges?
I would answer it in 2 parts. One is, as far as challenges are concerned, I don't think so we are facing challenges. Yes, there are some delays, which is in the normal course of business, but nothing alarming as such.
Sure, sir. And so any ROC target or like a range that you aspire in the next 4 to 5 years, which possibly you might achieve by cloud scales or hardware service scales? Is there any number or a range that you're working on?
We would not like to get into forecasting or projections. That is something that we will refrain. But yes, we are very clearly working towards growth as far as the business is concerned.
Sure, sir. Sure. Thank you so much. That answers my question.
Thank you.
Thank you. Reminder to all the participants, anyone who wishes to ask a question may please press star and one now. We have the next question from the line of Parth Vasani from KK Advisors. Please go ahead.
Hi, thank you very much for the opportunity. I had a couple of questions.
Mr. Parth, I'm
First,
sorry to interrupt. You're sounding too distant. Can you please use your handset to ask a question?
am I audible now properly?
Yes, please proceed.
Okay, thank you. So I had two questions. Could you give us the revenue contribution segment-wise for this Q2 and H1 FY23?
So we normally do not want to get into breakup of revenue, but I'll give you a ballpark figure between consumer and the enterprise and the cloud business. I think it would be, for H1, it would be in the region of 60-40 ratio.
60 would be for consumer, right?
Yeah.
Okay. Okay, so that helps. The second question was, can you give me some insight on the new brand partnership which you have signed and the business opportunity from that partnership?
Yeah. So the new brand that we have signed is called RNM. It is a global brand, and they are doing fairly well, not only globally but also in India. And we are very, very happy to get associated with them. We've already signed the agreement and are in the process to kickstart the business. This is into structured cabling business, what we would call as passive networking products that goes into providing cabling and all for the networking products. And offers, they're doing reasonably well in India, and we together expect it to take to newer heights. We would not like to put a number to it because it takes about 6 months for any new brand relationship to get settled down within Compuage system and the partner ecosystem. But it will definitely contribute towards growth and, more importantly, towards a healthy bottom line.
Okay, got it. So yeah, that was helpful. Thank you.
Thank you.
For the opportunity. Yeah.
Thank you. Anyone who wishes to ask a question may please press star and one now. We have the next question from the line of Akash Mehta from Kipes Investments. Please go ahead.
Oh, sir, good morning. I wanted some more color on the nature of services. Basically, what do we do in our services vertical, and if you could give me some color on the margins of this business, and if we aim to scale it up in the future.
So, as a distributor, we do not need to get into hardware services. The services responsibility lies with the brand and the principal company. But we saw an opportunity with our nationwide infrastructure, and that is what prompted us to venture into hardware services as a separate business unit within Compuage. What we do is, as an infrastructure, we have 69 service centers. We have more than 300 engineers on our payroll providing these services. Now, let me give you an example. For example, if you bought one of the services that we provide is for ASUS laptops. If you bought an ASUS laptop and you have a problem with the product, you would call the toll-free number. The toll-free number would direct you to one of the ASPs, we being one of the larger ones. When the call is directed towards us or the customer is directed towards us, we would fix the problem during the warranty period and get compensated by ASUS. So we have about 7 or 8 brands that we represent for services, and this is how we provide services on this business. It offers a healthy double-digit margin, and therefore we are trying to focus on this business.
Okay, so double-digit margin as such. And what kind of a revenue mix do we have currently, and what is the steady state mix that we target in the future?
It's a service revenue, where the contribution is very, very low. Currently, the top line contribution is less than 0.5%. So we cannot talk about what is the revenue contribution it will play in the company, because in distribution business, the other businesses offer a healthy top line. But the objective is to complement the bottom line and help the bottom line grow.
Okay. Yeah, thanks. That's helpful.
Thank you.
Thank you. Participants may please press star and one to ask a question. We have the next question from the line of Anup Shah from Srinath Securities. Please go ahead.
Yeah, thank you. Sir, I just had two questions on the right issues. Just wanted to understand where are the proceeds going to be utilized, and is the promoter group going to participate in the right issues, and if yes, how much?
So the rights issue proceeds are primarily for the growth of the organization. It is towards the growth and contribute towards its working capital needs. There is no other requirements, no capex, no inorganic growth plans or anything. So it's a very organic business that we are trying to grow by. And yes, the promoters will be contributing to the rights issue. And in terms of the quantum, that is something that we would not be able to share at this moment. But promoters are definitely going to contribute towards the rights issue.
Okay, sir. Thank you.
Thank you. We have the next question from the line of Karan Mehra from Mehta Investments. Please go ahead. Mr. Mehra, I've unmuted your line. Kindly proceed with your question.
Yeah, am I audible?
Yes, please proceed.
Yeah. So thank you for the opportunity, sir. Yeah, my question is, what is your outlook on scaling up of a hardware services vertical?
It's a tough business. Why it is tough is there are very, very few organized players like us. Most of them are individual mom and pop shops. They operate as ASPs, and therefore sometimes they are willing to operate at lower margins, and therefore we are constantly fighting with the brand owners to pay us in line with what we can offer in terms of nationwide services. So it's a tough business, and we definitely want to stay put because it offers us the opportunity to increase the bottom line of the organization. Having said that, yes, we are in it to scale up the business. We are only not making projections or forecasts at this moment.
Okay. Okay. And also, if you can help me with, like, in which categories are you focusing on to grow the business in future?
So categories remain basically the PC hardware category. We are there in laptops. We do selectively smartphones. We do peripherals like printers, scanners. So it's the basic PC hardware category of products.
Okay. So that answers my question. Thank you.
Thank you.
Thank you. Reminder to all the participants, anyone who wishes to ask a question may please press star and one at this time. We have the next question from the line of Ashay Jain from Jain Capital. Please go ahead.
Yeah, hi. I have a couple of questions. Firstly, can you provide gross margins for each of the business segments?
We are not providing divisional accounts and margins, so I regret will not be able to provide that, but I will give you a broader outlook. Basically, the consumer business offers lower gross margins, and the enterprise business offers higher gross margins. Having said that, the consumer business has lesser value addition, has shorter working capital cycles. The enterprise business requires a much more value addition by the distribution companies and the partners, and therefore has higher investments. It also has higher working capital cycles. So the way the company looks at it from the business perspective is what is the ROI that any product line would contribute to the business, rather than looking at pure gross margin, because it does not give a true reflection of contribution to the company.
Understood. That's helpful. So secondly, can you throw some light on the guidance in terms of revenue for specific to cloud managed service and the overall cloud business?
Cloud business is growing. We will be adding more brands in that portfolio in time to come. We are also working on creating our own portal for cloud offerings to resellers. So that gives you an indication of our focus on this business, but we will not be able to make forecasts or projections for the division or any of our businesses.
Okay, got it. That's all from us. Thank you.
Thank you. We have the next question from the line of Priyanka Shah from NM Securities. Please go ahead.
Thank you, sir, for the opportunity. Sir, I just wanted to know what is the company's debt as on September 22 and what is cost of debt?
So the company's debt as on September 22 is approximately 450 crores, and the cost has gone up of lately with what all has been happening in the marketplace, and I think it would be in the region of about 10, 11, 12%.
Okay, sir. And what kind of EBITDA margin can we expect in 2 to 3 years?
We are definitely working towards enhancing the EBITDA, and the PAT is all I can say at this moment.
Okay, sir. Thank you so much.
Thank you. Participants may please press star and 1 to ask a question now. We have the next question from the line of Asim Bharde from DAM Capital Advisors Limited. Please go ahead.
Yeah, hi, morning. Sir, just can you talk or give a sense on working capital between the enterprise and non-enterprise portions of your business? And maybe if you could break it down between receivables and inventory?
So I can give, as I've given a broad indication, I can give you a broad indication.
Sure.
As I mentioned that the consumer business operates on shorter working capital cycles, and the enterprise business works on longer working capital cycles. In terms of I mentioned that our average working capital cycle, net working capital cycle, is in the region of 50 to 55 days. I think the consumer part of business would possibly be operating at about 40 days, and the enterprise business would be operating at a higher days of maybe 65 or so. That is the kind of indication I can share with you.
But is there a gap? Is that being fueled through your receivable days, or is it the inventory portion that actually factors for the difference?
So in the consumer, the inventory is higher. In the enterprise, the receivables are higher.
Okay. Sure. Thank you.
Thank you. You may please press star and 1 to ask a question. As there are no further questions from the participants, I now hand the conference over to Mr. Atul Mehta for closing comments.
Thank you everyone for joining the call. I hope I've been able to answer most of your queries. In case of any further queries, you may contact SGA, our investor relations partners. Thank you.
Thank you, sir. On behalf of Compuage Infocom Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.